the rhythm that is needed. So what's your view in this point about driving focus in terms of segmentation, positioning, um, etc.?
So with, I think without answering what should the goals be for any given company, right? Because that's always unique. I think in terms of taking the time to think it through, I think, as I mentioned earlier, one of the things is getting the time out to think about, what do we need to change, what really matters, and how these priorities shift. But I think the other thing that often plays a big role in there is trying to make sure that people actually have the information they need to be able to make those decisions, right? And if I start with a detailed example, right? If you take product management, and when people are thinking about what's on their roadmap, at this point, it's one thing to say, we should add these features to let us do a new vertical. Or maybe you've got a decision of maybe if we add, these different features, that's going to make our implementations faster, right? Just to take like a general thing.
Right.
And I think
Yeah.
starting to come up with a way to bring these first ideas from the whole team, but then also to start to have the data that would let people make that trade-off themselves, right? And fitting it into the plan, right? And I always like to think, even if it's not right, because these things are difficult to estimate, but to start thinking about what would that mean, right? If we could do a faster implementation, what does it cost us? Does it save us like a week of a customer support person, or does it save us a month? Again, something that lets us get into a new vertical that even if we can't quantify it, we know is going to be much more valuable for the company because now we've proven this works in multiple, right? And I think so the first thing is just making sure that you're able to do these trades, get some of the operational and financial data together to make those decisions. But I think it needs to flow all the way down the company, as you mentioned, right? That, you take the big picture thing of, maybe it's how do we get into this vertical? And then it flows all the way down through the organization in terms of what each person should be pulling towards.
Correct. And usually, we know a lot of stories of companies who needed to have courage in a certain moment of their lives. Usually those moments of truth for companies, sometimes going from Series A to Series B, that they need to shut down a part of the business, not a very successful vertical, but a relatively successful vertical, to double down on a very successful vertical and maybe lose 50% or 30% of the revenues to scale faster and to have the company focus on. And this creates a lot of fear given the pressure that, again, we need to double, triple the revenue, and sometimes doing the trade-off in the short term for what are the results and the speed of growth in the long term. So very, very good point here. And yeah, go ahead.
Yeah, well, and I was going to say, in one example, which is actually from before I was invested, a company called ZenJob that we're invested in Berlin, which is a marketplace connecting students into temporary work across Germany. When these guys got together, they got legal advice. They put together the contracts they thought would, be right for the regulatory environment, and started growing fast, right? While they're putting this all together, going through the phase where everything was put together with WhatsApp and Google Docs to, building out more and more product. And then they hit a point where actually, they realized that the contract structure they had used was not right for what they wanted to do. And in this case, the risk was actually a different one, which is that the guys are personally liable for breach of employment law in Germany. So the risk people are taking at this point is not, slower growth here or there. It's if we get this wrong, we could lose our house, right? We could, these are proper risks for the team. And I think at that point, the guys, had a conversation. They decided, look, actually, let's take the time. Let's get these contracts right. Let's, put down a solid foundation, even if it means it's going to slow down our growth for a period, so that we can restart growth and accelerate from this point, right? And they did it. It was a open conversation. They worked out Does this mean differences in terms of the team? And it let them sort of restart for the next phase of growth, right? But I think that culture of also, just being open with each other and saying, look, are we all, because different people always have different risk profiles, right? So, you get it very often with businesses that have been around, much longer than those guys have, right? With there's someone who's been running it for 25 years, who doesn't really want to take big risks anymore, right? They're kind of getting towards the end. They're starting to think about exit. They don't really want to do anything else. And I think sort of rebalancing that risk profile across the team is also something that's often, catalyzed by investors coming in.
It's a very, very good story to simplify the importance of focus and the importance of taking very difficult, or having the courage to take very tough decisions for the best of the company that might be very difficult in the short term, but is the best thing in the long term. And here, that's where also having very good investors backing us and advising us is important, to understand that we might need to take another path to get to the same result in the end.
And there's just as a sort of contrast, right? Because the right answer is not always product, right? So I think oftentimes when people are going, through these stages, there's another one of our portfolio companies where the guys are getting frustrated with the fact that they had a team of people who were taking data from, one format and putting it into another. And they wanted to build something that would automatically, in this case, actually was another recruiting business. They didn't want to have to get these guys looking at it. They wanted to build something that would automatically understand all this data and reformat it into what they did, and mapped out how much development time this would be. And in that case, when we sat down and said, look, what is this really costing us? And the reality is they had a team, outsourced in another market doing it. It really didn't cost much at all relative to what we made on each of these placements. In which the right answer is actually forget automating it. Why don't we just triple the size of that operations team? And when we're bigger, we can worry about doing it, right? But at this point, there's just other things to prioritize.
Very, very good point, and another very good point. And we are coming to Rockefeller habit number 3, and it was also a very good complement on Rockefeller habit number 1. Again, having different personalities with different profile risks in different moments of their careers, in different moments of their personal lives, and kind of understanding well each other, having good conversations, talking about the tough issues and making the tough decisions together. And here we can also go into something which is very relevant in the investment industry, which is, should we take decisions by a consensus or by a contrarian approach? But let's not go into that direction. If not, it will be almost an episode just about this. So Rockefeller habit number 3, it's really about execution. So having the proper meeting rhythms in place. So having the daily stand-ups, having the weekly meetings, the monthly meetings, the quarterly offsites, the annual offsites, as we were discussing before, making the time to think about what is the leadership team 2.0, 3.0, what is the focus that we need to do in the next stage of growth, what we need to bring to do to get to the next campus in climbing the Everest, and what is the main milestone, the next milestone part for the company. Usually this is another point where teams, and especially founders who come from a startup mindset, who don't believe in the corporate world and having a lot of meetings in bureaucracy, and they start looking to these meetings as a waste of their time, which is so precious, that they should be outside doing things instead of discussing the business, aligning people, focus, accountability. And it seems that they sometimes even ask themselves as their life plan if it doesn't make sense for them to keep leading the company, because they are hating what they are doing in this new stage of the company. So do you see this kind of issues happening across your portfolio, and how do you help if you see them?
So I think maybe it is useful to think about what goes wrong with meetings in lots of big companies, right? And I think if you start taking an organization that's got 50,000 or 100,000 people, the reason you have committees and the reason you have these meetings is by and large because people are trying to avoid taking responsibility and avoid taking any decision, right? That, the sort of people sit together, they talk a long time, they all look at each other.
Very good point.
To kind of avoid the fact that there's, in the end, if I go back when I did a project with a mining company in South Africa at one point, and as we were thinking about the right organizational structure for their HR team, one of the miners told me, look, all I want to know is whose ass do I need to kick if something goes wrong? Right. And I thought that was actually a very good explanation of what is a good org structure, right? And I think, so I think that's it. If you take these big organizations, that's what's happened, right? It's like it's no longer clear, whose butt is actually on the line for this. So then when you think about what does this mean for a company that's going from 10, 20 people to 100, 200 people, up to the, 1,000, 2,000 level, I think for as long as you can, you've got to try and make sure that there's still clear accountability and you know who's doing what. But at a certain point, to be able to make decisions, you need to start pulling together information for a set of people who no longer bump into each other all the time. Right? When a company is 20 people all sitting in one big room, coordination is super easy. Everybody hears everything else. Somebody will be talking about, the strategic priorities for this quarter, and you can't afford 10 meeting rooms, so everybody else, hears what's going on anyway. Right? Once a company gets bigger, I think what you need is a way for that information sharing to happen. And I think, this is the meetings, right? It's a way of filtering this up so everybody doesn't need to sit in everything, but the right people still end up having all the information they need to make those decisions, right? But at the same time, you got to try and make sure there's still somebody where okay, here's who it was that made the decision.
Absolutely. Very, very good point. And especially on this meeting, on this Rockefeller Habits, we talk a lot about two tools of the framework to help companies to scale, which is the face and the pace. And the face is all about what you were saying, just assuring that we have the right people on the right seats executing what needs to be executed. And in terms of the pace, is really having the right people on the right processes in order to make things happen and having accountability and focus in place, which means that a person should not have a lot of hats and we should not have a strategic area or process or outcome of the company that doesn't have an owner. So if there is no owner, it will not happen. If there is more than one owner, it will not happen as well, because they will start looking to each other at the end of the month. And yeah, I thought that you would be doing that. And yeah, I thought you would be doing that as well. And we are all busy, especially in the Scaleup world. So, yeah, go ahead.
Now, the one thing I would add to that is, I think clarity about who did what and where's this data coming from and so on does not mean that when things go wrong, you do actually go, kick someone, right? Because the other thing is, like with all the companies that we're working with, there's a lot of experimentation going on, right? And a bunch of the experiments will be good experiments, a bunch of them will be, unsuccessful experiments. But I forget whose thing I'm stealing here now, but in the end, sort of even all the failed ones, you're still learning, right? In that way, that there's no failed experiment. You just learn that these 9 ways don't work. And that's how you work out the 10th way that's actually going to get you to the next level.
Thomas Edison.
Okay, thank you. I knew I was stealing it.
Not sure how many times it's said, but the idea comes from a very famous quote that I can't say, but I know what you mean.
And I think that's the thing, right? So I think the frame of it, if people are used to hearing about meetings in big corporates where they're avoiding deciding, they're avoiding anyone having responsibility, I think they just assume all meetings should be that, right? And we get it a bunch of times from, exactly as you say, right? You'll get the CEO of a company who hates the fact that they're in meetings all the time, not sort of doing. And I think that's actually just the natural evolution of the role of whoever's running the team. you spend less time in any of these details and more time thinking about how do I get the information flowing to the right people so this decision happens, right? When do I need to reorganize this structure so that that information still gets to the right guy? And,
Absolutely.
how do I try to do this in a way where everybody still feels super excited about what we're building, and, motivated to keep delivering every day?
Absolutely. Yeah, all very good points, and very very inspiring the way you put it, and sometimes even thinking about the decision making process and defining what is strategic, what is tactical, and what is operational. So if not, sometimes in a founder centric culture, the majority of the decisions are always coming to the same people, which will create decision fatigue and burnout, and also impossible to speed up execution because we are always coming to the same person to take a decision to move forward, which creates also the another point which is related with the face and the pace, which is the difference between authority, accountability, and responsibility. So accountability is the person who is accountable, will be counting what we want to achieve and what is the current status, and kind of saying this needs to move forward. It doesn't mean that I need to do it, but I need to inform the organization and the responsible people that we need to move forward and find out a solution to move this forward. Authority is the person who has the authority to take a decision about that, and the responsibility, usually that's a responsibility of the team as a whole. So even not being part of my job, I'm responsible for the results of the company as a whole, a team as a whole, even if I'm customer success and not in products. Also, it's not a product issue. No, it's a problem of the company. So it's my problem, it's my responsibility to help to solve this. So very good point, and we come to one
And I
of
would
the
say maybe just
yeah, right.
one other thought on that, right? I think, one of the things that sometimes goes wrong is, the company will get to a certain point and I don't know, they need a new head of sales, a new head of finance, head of marketing or whatever. And then they take somebody from, big company X, right? Someone who ran, I don't know, I shouldn't name it just in case I accidentally insult somebody, but some massive global company. They pick one of the Fortune 100 and they hire a guy, someone out of the Fortune 100. They hire somebody, and she's run finance at this big company, and you put them into a startup. And I think sometimes what goes wrong is the sort of, to your point, the person who's you get a disconnect in big organizations at some point between the person who's actually doing the work, right? Somebody who's used to just being sort of, I think from your thing, accountable and sort of just sort of pushing things here or there, but who's forgotten sort of how to get their hands dirty, right? Whereas I think with
Correct.
all the stages we're working on, you need somebody who's simultaneously able to sort of get in there and, I don't know, negotiate a financing deal or close a big sale or do some big marketing thing, but at the same time has seen enough of these organizations to still be thinking about what it should all look like in the next 12 to 24 months, right? And is building towards those while still able to get their hands dirty. Right. And I think that's one of those ones where it's kind of tricky, so at some point, probably yes, those things separate out, but I think it's sort of also being cognizant of, what are the stages where you still need these together, right? Someone who's going to get in there and do things rather than whose first thing is to hire a bunch of people who then go do things.
And that's why the ENPS and being able to attract great talent and being able to be a factory of leaders is so important for a scale up. So if we are not producing leaders at a pace that allows to grow quicker than the business and to grow the current ones that we have in the business as quicker as possible, we might have a growth bottleneck. So I love the factory of leaders concept, and that's why it's important to be the best place to work in the category, the company or the product or the service that the clients love the most in the category. And that's why we are always talking about Champions League of business in venture capital, venture-backed businesses, because it's really very high standards, very high quality at a speed of growth that is really overwhelming for any person that is going through the process, even for the most experienced ones, as we see again in Olympics, right? That the best athletes, the best tennis players, the best soccer players or football players also are facing a lot of stress, being number 3, number 2, or number 1 in
Right.
their place.
And I would say actually, some founders, some CEOs, some heads of sales when the companies are small, whatever, they will grow and learn and be able to keep doing these things, right? But sometimes the bottleneck is actually is actually the person themselves, right? Realizing this is not their forte, right? There was one company where the CTO, right when they started, brilliant technically, could code spectacularly, but terrible organization. Couldn't manage to get his domestic bills paid on time. Was always late on all these things, and was supposed to be running this engineering team. And it took a while, right? The guy was sort of struggling, and sort of when we took him out of that role and hired somebody else who was just really the head of engineering, doing all the product management, and let the guy just do the coding without sort of having to manage everybody else, he was actually just much happier, right? That when we made the change, the guy realized, look, actually, I was never really good at that. I was feeling uncomfortable, but was critical to the development of the product, right? Like brilliant, knew what was going on. So I think sometimes realizing when you need to know those changes matters. And sometimes it's, sometimes the egos do come into it, right? So there's another company where I remember at some point, and I won't name which one it was, but I was at the drinks for the company, and on a Friday night after a bunch of beers, like I was with some of the salespeople who were complaining about the cap on the commissions. I was asking them, like, well, what cap, right? And these guys were all laughing that I didn't know. And basically there was an unofficial cap where none of the salespeople could make more money than one of the founders, right? So and it's clearly broken, right? And the net result was it screwed the sales process. People would deliberately defer things because they knew they couldn't get paid more for it. And then the way we ended up resolving that is somebody on the board at the time, had run very successful business before, and had and we got him to speak with one of the founders, the particular one where this came from, and say that, look, at the time he had 20 salespeople who were each making more in cash than him, multiples of what he was making every year. But recognizing that, look, in the end, these people are working for your equity, right? If they make the company more valuable, it's short-sighted to think about that constraint, right? And you have to just realize, they're bringing a lot more to this company, right? And you just need to take yourself out of that. But I think there's always things like this hiding within companies, and often people don't realize that they've put these bottlenecks in there.
Very good stories, and thanks for bringing the stories that creates much more value to the audience and to the concepts that we are discussing here, that sometimes are a little bit theoretical, but having your stories and real examples of your portfolio is really super helpful. So and we are coming to the end of the podcast. And I need to apologize our audience and yourself, Imran, as well, because we had a lot of technical issues during this podcast. Not sure what is happening between the connection in between Zoom and Facebook Live. But I think that's a good part of the episode is being covered. So maybe later we'll need to have you back to kind of approach another stories. But before coming to an end, there is still an important topic that we can never avoid when we are talking about businesses that are growing at this pace, which is the importance of cash. So, and we all know that if we run out of cash, we are out of business. And is there any kind of examples or any kind of tips or advice that you give to your portfolio in managing well their cash, in having enough oxygen, but not also spending too much, but at the same time being aggressive? So how should we manage cash? That's a very broad question, but we also, given your background, you might be able to help us to understand this concept better.
Right. So, I've invested across gaming businesses, e-commerce businesses, SaaS businesses, marketplaces, and I do think actually, in the end, across all of them, I like to draw a simple chart, which is just, on the x-axis, how many, months since you signed up a customer, and on the y-axis, what's the total cash you've got out of that customer, right? And every investment has a J curve, right? You have to spend money on marketing, you have to spend money on sales, you have to spend money on onboarding, and then along the while, hopefully you bring in somebody you're making money out of over time, right? You get annual payments on a SaaS thing, etc. But I think being very clear about the unit of growth. So it might be a salesperson, and think about, do I hire another one or not? It might be a branch. Do I launch another one or not? It could be a city. Kind of the unit for each business varies, but I think you need to be clear, what is the unit that matters for your business? And then what are the real economics of that? Right? And I think as long as people are clear on what's going on, and that if you're in a phase where you're burning money, you're confident that you're doing it because you're going to make more money in a reasonable timescale, I think, then I'm 100% a fan of growing faster. But you need to be clear on it, right? And I think as a sort of perhaps counterexample, I would say, if you remember when Groupon was first going public, they came up with this concept of EBITDA, right? Their EBITDA excluding
Correct.
all their marketing, which was because they were burning all this money, and their idea was they were creating value on that. But in the end, actually, the cash was telling the truth, right? They were pouring loads out, not getting as much in as they should have at that time, right? Although obviously they sorted a bunch of things out afterwards. So I think being clear on that really, really does matter. And I think what has made that harder for people is that in the last 10 years, there's so much more money coming in to fund private companies that you can actually hide it for a long while. If you're a public company with 10 billion of revenue, funding losses of $1 billion a year used to be very difficult, right? Still is in the public markets, right? But kind of changing maybe with some of the IPOs recently. But if you're burning 10 million a year, or 20 million a year, or 30 million a year, actually there's a lot of people who are still funding those, and people can end up sort of convincing themselves on what are fundamentally not solid economics, right? And I think this is just a little bit of temperament, but I do think, just focus on what is the unit of growth that matters for your business, and then what is the cash that goes in to launching one and that you get back over time.
Very good point. And is there any example of a unit economic that is relevant, especially for a SaaS or enterprise business?
Well, there it's often the salespeople, right? Or we'll look at how long does it take to ramp up a salesperson. When do they get productive? What are they bringing in over time? Or looking also just sort of per customer economics, right? And understanding kind of exactly as I was saying there, right? Like, what's the sales process? What's the implementation? When are they paying back? Those are the two most obvious when you're looking with the SaaS businesses.
Got it. Very good point. And just also a final point, which is not so much related with cash there, but it's also related with your the speed of growth, which is the SaaS napkin, which is always a very good reference and benchmark to me. So for the ones who don't know in the audience, the SaaS napkin, you can just Google it, and Christoph Jens, which is one of the partners of Point Nine Capital in Berlin, that is invests across SaaS and marketplaces. The SaaS napkin, as the name says, it's for SaaS businesses, and he believes in a certain growth rate, namely 2.5 or 3x, depending on the stage of the growth. And if I'm not wrong, the SaaS napkin has seed stage, Series A stage, and Series B stage. I think there was any version that had Series C, but nowadays I think that especially the last version where I'm aware of doesn't have Series C anymore. So again, I asked this question in our last VC interview. Do you believe that this kind of double, triple, or 2.5x growth is really important to happen in order to stay on our pace to be category leader, and also to be interesting to attract the right investors for the next round, and to be able to accomplish the milestone in order to get to the BIAC? So what is your opinion on this?
So I really like the point nine guys actually, and I think they got their heads properly screwed on there. I think you can even order the napkin off them online. So if you
Yes, you can.
uh, I'd say for me the thing that there are lots of people out there now who will get excited and fund a business just because of the top line growth, and I think many who, to my mind, do not know enough or do not care enough about what's going on under the hood to know if that's sustainable. And it's literally a thing that I was debating with somebody at lunch yesterday, as to whether, what do we cost our portfolio by telling them, look, actually build a sustainable business that works? Because maybe that's actually harder to fund in this environment. Maybe we should be telling them to put their foot down, don't worry about it, right? But I think in the end, you have a sustainable business, you know your economics are strong, you're growing at a growth rate that is, good, right? I think there's not anything, I think like everything in our portfolio is like north of 50%, right? I think we looked at it, I think the aggregate was like 80% something year on year last year. And they're all at very different stages. But I think with all of them, what we're focused on is, are they solid businesses? And as long as they're solid businesses, I think then the key driver of how fast you grow is how much you're investing. And I think that's a trade that everybody makes differently and makes different sense for those. But I think that's to me the key thing. Like, make sure you build something solid, and when every downturn comes, people suddenly remember that actually you do need to make cash to stay in business, right? People forget about it in bull markets. They
Yeah.
forget about it when it's easy to raise money, but it will come back, right? And then if you know you're solid, I think that was Buffett, wasn't it? Right? It's when the tide goes out, you find out who's been swimming naked.
Correct.
You corrected me last time we were talking about that one. Yeah, so exactly that, right? So I think that's the difference, right? The guys with good unit economics are wearing that like a shield.
Absolutely. Very, very good points. And yeah, a lot of opinions here. And good to see this healthy approach on the investment side as well. And we could go also here in the discussion of European American style, which is also very common in a lot of blog articles. So when we now are really coming to an end, and one of my favorite questions, which is if you would have the opportunity to meet yourself, Imran, at the beginning of your investment or VC or corporate VC career, what would you tell you, or what advice would you tell you in one sentence?
I think in the end, it's always just realizing that in the end, you should care less what other people think. Right. I think with all these things, there's many times we've looked at a business, we've decided it was good, it was not good. Somebody else does the deal, somebody else raises a lot of money in a vertical, and everybody wonders, are we doing the right thing? And I think the thing to realize is, especially in our industry, the cycle is so long, you won't really know for another 5 years or 10 years for some of them, whether you were right on that call or not. And I think it's the same with founders running businesses, right? Like this is not a sprint. It's going to be over years that you doing the right thing is going to pay out in success. So I think try to be even more patient and think 5 years, 10 years out would be the thing I try to tell the younger self.
That's an amazing tip. And again, apologies, Imran, for the technical issues that we had today, and I think that we'll not have the full episode and the full lessons that you shared so preciously today. We covered just 3 of the 10 habits and a lot of lessons and stories from yourself. So which means that we have at least another 7 to cover together in upcoming episodes. So you are invited to come to the show whenever you want to share additional stories of your portfolio. And thank you so much for joining us today.
That's good. Thanks for having me, Miguel.
A pleasure. So for our community, as you know, it's really a pleasure to host you and to welcome you every week. We compress the key lessons, and we are totally obsessed about this, of scaling a company from 1 million 200 million annual recurring revenue. You can watch, listen this episode when it's most convenient to you, where it's most convenient to you, on Spotify, SoundCloud, YouTube, iTunes, etc., etc. So the key platforms we have the episode available. There is an article with a summary that will be published soon in our blog at scaleupvalley.com. Feel free to suggest us new topics, new guests that you'd like to see in the show in order to keep our mission of helping the leading scale-ups of today become the tech giants of tomorrow. So see you next week or very soon, as we are already on almost 75 plus episodes at this stage during the last 2 years and working on the mission since 2013. So see you soon, and thank you very much for making your time.